Here is a number that should stop you. Charlie Munger spent the first 70 years of his life as a lawyer. Not an investor, a lawyer. He did not join Warren Buffett at Berkshire Hathaway until he was 47 years old. He did not become a billionaire until his mid-70s. He died in November 2023 at 99 years old with a net worth of approximately $2.6 billion, and he built most of it after most people have already retired and accepted their financial life as fixed. Here is what that tells you. The single most important factor in how Charlie Munger built wealth was not which stocks he picked. It was not when he started. It was how he thought. The framework he built in his mind over decades, what he called a latticework of mental models, that is the thing that compounded. Not just his portfolio, his thinking. And almost none of it is taught anywhere. Most people who know the name Charlie Munger think of him as Warren Buffett's sidekick. The supporting character, the one who sits at the Berkshire annual meeting and occasionally says something funny and sharp before deferring back to Warren. Buffett himself has corrected this misunderstanding repeatedly. He has said that Munger transformed his approach to investing more fundamentally than any other person or idea he ever encountered. Before Munger, Buffett was a disciple of Benjamin Graham, buying cheap, mediocre businesses at significant discounts to intrinsic value and selling them when the discount closed. After Munger, Buffett became the investor the world knows, buying wonderful businesses at fair prices and holding them for decades. That transformation is Munger's contribution, not the trades, the philosophy. But here is the part of Munger's thinking that almost nobody in the personal finance space actually explains. His edge was not a better model for valuing companies. It was a better model for thinking about everything. Munger spent his entire career reading voraciously across disciplines that most investors never touch: psychology, biology, physics, engineering, philosophy, mathematics, history. He read, he understood the foundational ideas from each field, and he wove them into a single decision-making framework. What he was building was not a stock-picking system. It was a system for being wrong less often. He put it this way in his famous 1994 speech at Usk Business School, which is one of the most important documents in the history of investing. You've got to have models in your head, and you've got to array your experience, both vicarious and direct, on this latticework of models. That sentence is the entire philosophy compressed into 2 lines. Not which companies to buy. How to think, and thinking well, compounded over 99 years, is what produced $2.6 billion from a man who started as a lawyer and became a billionaire in his 70s. Mental Model 1 Inversion. Munger borrowed this directly from the 19th century mathematician Carl Jacobi, who famously said, "Invert. Always invert." The method is to flip every problem on its head. Instead of asking how to get rich, ask what guarantees financial failure, and then avoid those things systematically. Here is what makes this more powerful than it first sounds. Most financial advice is forward-looking and optimistic. What should I invest in? Where is the opportunity? Inversion forces a different question. What destroys wealth reliably? The answers are well documented. High-interest debt that compounds against you. Selling quality investments during market panics. Paying excessive fees for active management that underperforms. Making financial decisions in response to emotions rather than evidence. Munger's insight was that eliminating the obvious paths to failure improves your outcomes more reliably than identifying new paths to success, because failure is more predictable than success, and the same mistakes recur across generations of investors. Applied personally, before any significant financial decision, ask what could go wrong and whether you can survive that outcome. The margin of safety is not built by being optimistic. It is built by being honest about the realistic downside. Mental Model 2, the Circle of Competence. Munger and Buffett developed this model together, and it is widely known but consistently misapplied. Most people interpret it as invest in what you know. That is not quite right. The precise formulation is: know the exact boundary of what you do not know. The size of your circle does not matter nearly as much as the clarity of its edges. Munger put it plainly: knowing what you don't know is more useful than being brilliant. The investors who consistently overpay for mistakes are not the ones who understand their field poorly. They are the ones who stray outside it into industries, instruments, and geographies they have superficial familiarity with, but not genuine understanding, and mistake confidence for competence. The technology investor who pivots to biotech without understanding drug development is not expanding their circle. They are walking outside it and pretending the boundary does not exist. Munger's version of this model extends beyond investing. In your financial life, the most expensive decisions you will make are the ones where you overestimate how well you understand what you are doing. The fix is to apply a simple test before any major financial commitment. Can you explain this clearly to someone intelligent who has no background in it? If the explanation requires the other person to simply trust you rather than follow the logic, you may be outside your circle. Mental Model 3 incentive bias. Munger considered this the single most underappreciated force in all of human behavior. His formulation was simple: show me the incentive, and I will show you the outcome. People respond to incentives often unconsciously, often at odds with the advice they are giving or the values they believe they hold. The financial services industry is the most vivid real-world demonstration of this model. A financial advisor, compensated through product commissions, has a fundamentally different incentive from a fee-only advisor who charges a flat rate. Both may believe they are acting in the client's best interest, but the commission-based advisor is structurally incentivized to recommend products that generate commission regardless of whether they are optimal for the client. The incentive shapes the recommendation before any deliberate decision-making occurs. Applied to your personal financial life, every piece of advice you receive comes from someone whose incentives are visible if you look for them. The broker who calls about a specific product, the influencer whose platform is sponsored by a brokerage, the advisor whose compensation depends on assets under management growing. Before evaluating any financial recommendation, identify who benefits if you follow it. That question does not make the advice wrong. It tells you what weight to give it. Here is where this conversation typically goes wrong. People hear about Munger's mental models, find them intellectually interesting, and file them away as interesting ideas that apply to professional investors evaluating multi-billion-dollar businesses. That is not what Munger intended. He believed and said explicitly that this framework is most useful for ordinary decisions, because ordinary decisions are where most people make the costly mistakes that professionals avoid through institutional discipline. Let me apply each model directly to a financial decision most people face. Inversion. Applied to debt. Instead of asking how to pay off debt faster, ask what guarantees you will be in debt permanently. The answer is consistent. Maintaining the minimum payment, accumulating new debt while carrying old, and treating debt as a normal financial condition rather than a temporary one. Identify those behaviors. Eliminate them systematically. You will have applied inversion more usefully than any particular debt payoff strategy. Circle of competence. Applied to investment selection. If you cannot explain in plain language what a company does, how it makes money, what could put it out of business, and why it is worth what the market says it is worth, you are outside your circle. That does not mean index funds are your only option. It means your honest circle of competence determines where you invest your own money and where you rely on diversified exposure to the broader market through index funds, rather than pretending to know what you do not. Incentive bias. Applied to financial advice. Before following any advice about money, name the incentive of the person giving it. This does not require cynicism. It requires one question. How does the person recommending this benefit if I follow it? The fee-only financial planner. The commission-based broker. The sponsored personal finance influencer. The employer's human resources department during open enrollment. All have visible incentives. Understanding them does not make the advice wrong. It tells you how much independent verification is appropriate. Lollapalooza awareness. Applied to investment decisions. When you find yourself excited about an investment, look for the convergence of forces. Is the excitement coming from the fundamentals, revenue, earnings, competitive position, valuation, or from social proof, media coverage, recent price movement, and the fact that people you know are making money on it? When social proof is doing more work than analysis, that is a Lollapalooza environment. That is when Munger's model says to slow down rather than accelerate. Second-order thinking. Applied to financial planning. The decision that improves this month's cash flow often has a second-order consequence that worsens the 10-year outcome. The lease on the slightly more affordable car that keeps you from saving toward the down payment. The impulse buy on a credit card that feels small but resets the payoff timeline. The refinance that lowers the payment but extends the term by 5 years. Munger's framework asks you to follow every significant financial decision through at least one additional layer of consequence before committing. There is a fair version of the skeptical argument. Munger developed this framework in an era of different markets before passive investing dominated price discovery, before algorithmic trading accounted for a significant share of daily volume, before AI began to compress the information advantage that careful human analysis once provided. The argument goes, if the market is more efficient in 2026 than it was when Munger was building his approach, the mental model advantage is smaller. That argument has merit for the specific domain of individual stock selection. The markets for large-cap U.S. equities, traded by thousands of professional analysts and increasingly by algorithms, are more efficiently priced than they were in the 1960s and 1970s. The informational edge available to any individual investor in that market is smaller than it was when Munger was developing his framework through deep reading and careful analysis. What has not changed is human psychology. Confirmation bias was as active during the 2021 meme stock mania as it was during the 1999 dot-com bubble. The Lollapalooza effect produced the same convergence of social proof, fear of missing out, and easy credit in crypto in 2021 that it produced in technology in 2000. Incentive bias shapes every financial recommendation in 2026, precisely as it shaped every financial recommendation in 1976. The models that describe how humans systematically make mistakes with money are not outdated. The markets they operate in are faster and more liquid. The psychology has not changed at all. Munger's framework is at least as relevant in 2026 as it was in 1976. What is more challenging is that the investment tools have simplified. Low-cost index funds exist. The evidence for their superiority over active stock picking is documented in 20 years of SPIVA scorecards. The behavioral challenge is not lack of access to a sound strategy. It is the emotional resistance to a strategy that is too simple to feel like it is working. Munger's models address that resistance directly. The Lollapalooza effect explains the bubble that tempts you away from your index fund. Inversion reveals that the most reliable path to underperformance is what you are most emotionally drawn to do. Munger was asked in his final years what he would tell a young person who wanted to build wealth over a lifetime. His answer was characteristically direct. He said, "Go to bed smarter than when you woke up." Not, "Pick better stocks." Not, "Find a superior asset class." Not, "Optimize your tax strategy." Go to bed smarter than when you woke up. The compounding he was describing was not financial. It was intellectual. Small, daily additions to your understanding of how the world works, applied over 40 or 50 years, produce a decision-making advantage that compounds in the same mathematical way a financial investment compounds. Slowly at first, then in a way that is almost impossible to replicate quickly later. He built that habit so reliably that his own children called him a book with legs sticking out. He was still reading, still asking first principle questions about the world in the weeks before he died at 99. The latticework he was building never stopped accepting new material. The framework was never finished. That was the point. The question worth sitting with tonight is not which mental model to apply to your portfolio tomorrow. It is whether you are genuinely going to bed smarter than when you woke up, and whether you are compounding that in the same direction, with the same patience that Munger compounded his money. Because he would tell you those two things are not separate. I will see you in the next one. Bye.